Alright, so welcome back to another video on how to secure yourself, particularly looking at this beginner guide to financial statement. And to make this quick recap of these sections made by the sec.gov, so they mention that, well, if you're able to read nutrition labels or baseball or soccer box score, you can learn to read basic part of financial statement. If you can follow a recipe or apply for a loan, which is time consuming, you can learn basic accounting. And the basic is not that hard. There are rocket science. So this section is going to give us some confidence about how to read basic part of financial statement, much like a CPA class teach you how to perform basic cardiopulmonary resuscitation. But being able to look at this basic part and understand how to read this basic part of financial statement won't train you to be an accountant. Much like a CPA course won't make you a harder doctor. However, it can give you some confidence when you're able to see a set of financial statements and make sense of them. So, because of that, the question is, what are financial statements? And after all, they show you the money, right? From the immortal line, from Cuba Gooding Jr. Immortal Lines in Jerry Maguire movie, show me the money. That's exactly what financial statements do. They show you the money, where the company money came from, what is it now, and where it went. So there are four financial statements, balance sheets that show how that show what a company owns that has value and what it owns at a fixed point in time. Income statement is show how much money a company spent and made over a period of time. Cash flow show you the exchange of money between the company and the outside world, again in a period of time. And the statement of shareholders that show you is the change in interest of the shareholders, again over a period of time. So we're going to focus on the first three financial statements: the balance sheets, income statements, and the cash flow statement. So the first, it shows the company assets, liabilities, and shareholders' equity, where assets are anything that a company owns that has value. So they typically can be either to be sold or they can be used to make product and service that can be sold. So you have tangible assets, things that you can touch, such as inventory, machinery, tools, furniture, land, or intangible, such as trademark and patent. Cash is another form of assets and any investment that a company make. The liabilities is any obligation that a company needs to pay off money that a company owns to someone else. So, such as environmental cleanup costs, money owed to the supplier for material, for example, payroll a company owns to its employer, the rent for use of building, the money borrowed from a bank to launch a new product, and any of future obligation to provide good and service in the future. And the shareholders' equity is also known as the net worth or the capital, is how much is the money left over if all the company assets were liquidated and pay off all of its liability, all and pay off all of its liabilities to the shareholders, right? Or the owner of the company. So a balance sheet is generally laid out on a formula as the assets equal to the liabilities and the shareholders' equity. And you might find that on the left side, the assets, all the company assets listed on the left side, and on the right side, the liabilities and the shareholders' equity, or all the company asset list on the top, followed by the uh, liabilities and shareholders' equity. So company assets are generally listed based on how quickly you can convert them into cash, such as current assets or things that a company expects to convert within a year, for example, inventory, or non-current cash, things that a company does not expect to convert into cash, or it will take longer than a year to do that. And here we have is fixed assets, things that a company needs to run their business, and they're not for sale. Liabilities are generally listed based on their due date, and you have short-term interest, current liabilities, obligations that a company expects to pay off within a year, or long-term, due in more than 1 year. And the shareholders' equity, the amount of money owners invest in the company stocks plus or minus the company earning and it is or losses. So sometimes companies redistribute their earnings and they call that dividends. DLDR for this is that the balance sheet show the company assets. It shows a snapshot of the company assets, liabilities, and shareholders equity at the end of a reporting period, whether it's annually or quarterly, most of the time. But it doesn't show you the flow of in and out of the company. Income statement show you how much revenue a company made and the expense associated with earning those revenue in a period of time. So when you reach at the bottom line or the bottom of this financial statement, it tells you how much money the company made or lost, the company net earnings or losses. EPS is also something that you will find in a income statement, such as this is a calculation where indicate how much money a shareholder will receive if all the company or if the company decide to redistribute all of its net earnings, so we're going to talk about that later, to all of the shareholders, and companies almost never do that. In fact, they reinvest that in their business. So to think how an income statements are set up, think of them as a set of stairs where you start at the top, right? Let's say you wake up in the morning in your house, right? If you have a two house or a two floor house, right? You start at the top, and each step you go down, you make a deduction from it. Exactly, and each time you go down, you make a deduction, or each time you go a step down the stair, you make a certain deduction for certain costs associated with earning that revenue. And when you read at the bottom of the financial statement, you know if a company make money or don't. So we begin with the gross profit, the gross revenue here, which is the total amount of money come from sales of product and service. Then you go down. There's some amount of money that a company does not expect to collect, and here is, for example, merchandise returns or sales discounts. So once you subtract this sales discount or allowance and the merchandise return from the gross revenue, you arrive at the company net revenue. And you can think of them as a net because the revenue are left in the net uh, after deductions from allowance and returns have come out. The next section, okay, is some expense related to the how much money it costs to produce your goods and service to be sold. All right, and typically they call that the cost of sale, and you might find after the company net revenue. So this cost of sale, as I mentioned, it shows how much money a company spend to produce goods and service uh, to be sold, right? Then, once you subtract the cost of sale from the company net revenue, you arrive at the gross profit. And they call gross because there's certain deduction or there's certain expense that have not been deducted from it yet. So the name gross is because it's unrefined. So this gross profit, after that, there are some expense that you're going to deduct from it that are relevant to operate your business, to support business operation, whether it's administrative salaries, the cost of research for new products, uh, or marketing as well. Okay, and this is different from the cost of sale because you cannot link directly this operating expense to the production of good and service to be sold. So next we have is depreciation, which takes in account of the wear, the amount of use, and tear, the amount of damage of some assets, okay, like equipment, tools, or machinery, in which the period they were used, or in which they were used in the long term. So companies spread the total cost of these assets over the period they have used. And the process of spreading this is called depreciation or amortization. A great example of this is, well, calculating a straight line. So let's say you buy a laptop for 1100, you deduct 100, which is the amount of considered to discount, correct, or the amount that you're not going to get specifically for uh, this product because now you already use that. Okay, it's not brand new, and this amount of money may change and it depends on certain factors. But for the sake of example, let's going to say that this is $100 you're going to deduct from the total cost of your laptop, and then you're going to divide by the number of useful years, such as 5 years, for example. So this uh, amount is what you're going to deduct yearly from that asset. And if you want to, for example, sell that asset after 3 years, all right, you're going to deduct $750 from the $1,000, right? And this is what you're going to end up selling that, right? And after the 3 years, after the 3 years, I mean, it's not. Sorry, this is a wrong calculation. You have 1,000, okay, which if the total cost of your laptop it was 1,100, you deduct 100 for because this is not a brand new item anymore, and then you divide that result 1,000 by 5 years, which is the number of useful years, 1,000, and then you get is 200, right? So this 200 is what you're going to deduct yearly, and they call this straight line depreciation, right? So in the year, if you decide to want to sell this laptop after 3 years, well, you're going to deduct $600 from this laptop, right? And if you want to have a more very detailed calculation, well, I suggest you to go to other method of calculate depreciation. But again, this serves as a purpose to understand how to calculate that, at least a basic calculation, right? Or to get a basic understanding of that. Great. So after you deduct the operating expense, depreciation from uh, gross profit, you arrive at the operating income or income from operation before interest and tax income. So the interest income and expense, okay, so income from income, interest and expense, and yeah, is interest income, exactly. So interest income and interest expense. So interest income is the amount of money that a company made for keeping their cash, okay, in a saving account or in money market fund, whether it's, for example, um, mhm, um, yeah, or money market fund. So which involve is the purchase of large volume of very short-term debt products such as overnight reserve or commercial banks. And this type of debt-based financial instruments, they invest on commercial bank or short-term commercial bank debt, saving a certificate from issue from banks to earn some short-term maturity in unsecured short-term corporate debt or from government. Uh, to purchase this short-term government issue, right? So okay, cool. Because now with this, which again this is an instrument to earn interest uh, for keeping cash in this type of financial instruments, whether it's a saving account or a money market fund, and they should be used to as a place to park money before investing elsewhere or making an anticipated cash outlay. So they are not suitable for long-term investment. This money market, great, because now I look at the interest expense, which is the amount of money that a company needs to pay for borrow money. And then usually you might find this interest income or interest expense or, mhm, separately or together. So once you subtract or add from operation profit, you arrive at operating profit before tax income. And finally, income tax is deducted, and then you arrive at the bottom line, the company net earning or losses, right? And they also call the company net profit, net income, or net earning. And this tells you how much the company actually earned or lost during the accounting period. So did the company make profit or did it lose money? Okay. So if I look at the Coca-Cola here, right, from the income statement, they generally don't show you that KO announced cash dividend of 0.446 with an ex date of March 16, 2023. Dividends. Mm, okay. So the TLDR of income statement is you have gross revenue or total revenue followed by the cost of revenue. Then you have the gross profit, which when you deduct, when you subtract the cost of revenue or the cost of sales from the gross revenue or the total revenue, and then you reach at the operating expense that support the company's operation. And here you include is the administrative salaries, the cost of research for new products, marketing. Once you deduct that, you now reach at or you arrive at the operating income. Okay, after you deduct the operating expense and depreciation from the gross profit, you arrive at the operating income. Whether you have is after that the interest income and the interest expense. All right, how much money a company made for keeping their cash in a saving account or money market funds, and in expense how much money a company expect to pay for from borrow money. Sometimes you might find this separate or together. Okay, and then once you add or subtract this from operating income, now you reach at the tax. Uh, yeah, now you deduct is the income tax. Okay, now you deduct is the income tax, and you arrive at the bottom line. Now you deduct the income tax, and you arrive at the bottom line. But here they don't tell you this net income, total operating income as reported, and then you reach at the net income. Net income, exact, also called net income or net earnings, net profit, net income and net profit. And here you see how much money a company is making, and it is massive, man. And it is massive because this is all numbers in thousand. So this is not 9 million. This is 9 billions. Oh my god. Okay. 9 billions. No man, you don't have a you don't have idea. Oh my god. Holy cow. Coño, negar. Negar, negar, negar. So that was interesting because that was a huge overview of this balance sheets and the income statement. Okay, so I look at the balance sheet here, okay, and the income statement here, and the income statement. Okay, cool, cool. Now, let me take a look at the cash flow statement. So, earning per share is something that I already mentioned. That okay, is a calculation that tells how much money a shareholder will receive if all the company net profit or net income uh, were distributed to all of the shareholders, right? It's the amount of money that the shareholder will receive if all the company net earnings uh, were were distributed. The company usually don't do that. They reinvest that in the business. So now I'm looking here at the cash flow statement. So cash flow statement report a company inflows and outflow of cash. So this is important because company needs to have enough cash on hand to pay expense and purchase assets, according to them, right? For these two specific actions. So to pay expense or to purchase assets. Again, so the company, the cash flow is a report that shows the company's inflow and outflow of cash. Okay. So while income statement can tell you whether the company made, oh, yeah, well, income statement show you, can tell you. So while an income statement can tell you whether a company made a profit, a cash flow statement can tell you whether the company generate cash. And then you have these two uh, approach or this storytelling, right? So the income statements can tell you if the can tell you whether a company made a profit, and the cash flow statement can tell you whether a company generate cash. Okay, so cash flow statement show you whether a company generate cash, whereas with income statement, it can tell you if a company made a profit. Okay, okay. So a cash flow statement show change over time rather than absolute dollar amount at a point in time. And it use and reorder the information from the company balance sheet and income statement. Okay, so it use and reorder the information or the data from the company assets, from the company's balance and income statement, and a cash flow statement show change over time rather than absolute uh, dollar amount at a point in time. So it show is change over time according to them, right? So again, a cash flow statement can tell you whether a company uh, a cash flow statement can tell you whether the company generate cash. Mhm. And while an income statement can tell you whether a company made a profit. Okay. Are you profitable and can you generate cash? Interesting. Interesting. Okay. So income statement is that are you profitable? Alright? Yeah, this is the income statement. Are you profitable? So that report can tell you if a company made a profit, and a cash flow statement show you uh, yeah, and a cash flow statement can tell you if a company generate cash, and it shows the change over time rather than absolute amount of dollar at a point in time. Okay. So how much the cash a company generate over time. And the bottom line of the cash flow statement show the net increase or decrease in cash. Because after all, a cash a cash flow statement can tell you if a company generate cash. Can tell you whether the company generate cash. So this is the bottom line of the cash flow show the net increase or decrease in cash for the period. And generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of these type of activity. Okay, and generally, so now this is how cash flow statements are organized. Okay, and generally, the cash flow statements are generally not there are. So generally, cash flow statements are divided into three main parts. Each part review the cash flow from one of the three types of activities: operating activities, investing activities, and financial activities. hmm Interesting. So the TLDR for cash flow statements, okay, is a report that shows the company's inflow and outflow of cash. Okay, and this is important because a company needs to know, no, a company needs to have cash on hand to pay expense or purchase assets. An income statement can tell you whether a company made a profit. A cash flow statement can tell you whether a company generate cash, and they do that over time. So it shows the change over time, rather than the absolute dollar amount at a point in time. So when you look here at the cash flow here, repurchase of capital stocks, repayment of debt, insurance of debt. Free cash flow. For example, with Tesla, okay, okay, but it's very close. What about in the last 5 years? At the beginning of the bubble, blah, 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 there will be a market correction of 40%. Previous close, market cap, open 191.38. But here is the financials. When I look in here at the whole, when I look here at the cash flow here, is that they barely have cash flow. They barely have cash flow. Mm, mm, mm. 1 billion in cash. They barely have cash flow. So the TLDR from of cash flow statement is that it's a report that shows the company inflow and outflow of cash. And this is important because the company needs to have cash on hands to pay expense and purchase and purchase assets. So an income statement can tell you whether a company made a profit. An income or a cash flow statement can tell you whether a company generated cash over a period of time rather than absolute dollar amount at a point in time. This is something that to me is like, impossible. It's like, the hell is this? So the bottom line of the cash flow statement shows the net increase or decrease in cash. Mm-hmm. So the cash flow statement is used and reorder the information from a company balance sheets and income statement. And the bottom line of the cash flow statement shows the net increase or decrease for the period. And generally, cash flow statements are divided into three main parts. Each part reviews the cash flow from one of these three types of activity. Okay, this is the anatomy of it. Okay, so the anatomy of a cash flow statement generally are divided into three main parts, and they review cash flow from this type of activity: operating, investing, and financial activities. Mhm. Okay, so that'll be all for this video. Take care. Bye bye.